Dumebi Udegbunam is a fixed income trader at UBA. Joins me now for this discussion. Thank you so much for your time on the show, Dumebi. Let's get into what we're seeing play out there at this bond auction.
Good afternoon, Kenneth. Thanks for having me. So, as you all know, today is the bond auction where the DMO through the CBN is offering three maturities: 2027, 2035, and also an anomaly. The 2049 is being there and is replacing the 2045. So we see an anomaly compared to the previous auctions where we had the 2027, 2035, and the 2045. Now we have the 27, 35, and the 49. So we expect rates to hinge up a bit higher from where we are right now. From the last auction, the long end closed at 10.85. Right now, the market is doing 14 levels at the longer side of the curve. So we expect rates to hinge up higher. Market participants are also FSAging that. That's why we're seeing a lot of sell-offs at the bond side of the market to take advantage of this supposed higher yields at this auction, where we foresee rates going higher too.
But how do sentiments compare with the previous auction? And I also understand that there's some sell pressure also coming from market participants today.
So the sentiment right now is still the same as the previous one. However, there's an anomaly, there's a change. This month's auction, like I said earlier, the 2049 is being offered rather than the 2045. So there's a change. That means there's a clear sign that the government wants to borrow more and longer term. So market participants want to take advantage of this, because after this we switch back to 2045 at the June-July auction too. So we expect market participants and others to be heavily booked on that 2049 to try and see whether if they can win at these high levels and probably sell later to close the month profitably.
All right, but how does the activities we're seeing play out impact the tenors for longer term maturities?
Okay, so we are still really faced with system illiquidity in the market. We are with the hope or with the presumption that they still want to borrow more to more or less push the economy out of the recession. As we all know, we are currently faced with a revenue crisis right now, judging from where we are from the 2020 due to the pandemic. So we're facing a revenue crisis, and also we have a shortfall in the budget, about 5.6 trillion shortfall in the budget. So with the view by the DMO to borrow more, what we're seeing right now is a bit of sell-off by market participants in the secondary market to position well at the auctions to buy more at this particular maturities being traded. As you notice, the maturities are spread out between the three sides of the market, the mid, short, and the long term of the market.
But I'm curious to hear your outlook for liquidity before we wrap up.
We don't really have inflows coming in the market right now, so we expect the market to still be tight with liquidity. Currently, right now, we are at negative repo. This is the most times, like I've earlier said, where the market has been in repo since 2 years ago. So we are still in the right. I think we're in negative 96 billion in the market right now. To close the month and going forward, we still expect to see this illiquidity. As I've earlier mentioned, there is no coupon payments coming in the month of May, and the maturities are a far cry compared to where we're coming from Q1. So we expect this illiquidity to still linger in the market and the BS to dominate the market to close the week.
All right, and thank you so much for your time today. I've been speaking to Dumebi Udegbunam. He's a fixed income trader at UBA.